We keep hearing about the current trade war mainly in the context of tariffs, but that's only part of the equation. Beneath the surface, it appears the real strategy seems broader, focusing on what could be called a capital war and a currency war. In our view, the focus is shifting away from just reducing the trade deficit toward a wider set of goals designed to preserve the United States' economic influence. In essence, all of this could lead to a true global economic reset. And by reset, we mean the current system itself being shaken up and forced into a new equilibrium. See, when tariffs rise, they not only discourage imports, but they also push foreign investors and companies to put money into American supply chains. In that sense, the aim isn't only to cut foreign goods coming in, but to pull in foreign capital as well, reinforcing US production and countering China's growing economic power. When talking foreign capital inflow, we mean productive capital, like foreign direct investment, that builds and expands supply chains inside the US. High tariffs are deterrent to offshore production. That is an incentive for foreign firms to localize production, meaning capital inflows into US industry. If we look at the chart of US exports and imports, we can clearly see that since the start of this year there's been a sharp and unprecedented drop in imports. Similar declines have occurred in the past. However, those were always paired with a comparable fall in exports, which typically signaled a recession. This time, however, the situation is different. The decline in imports is the result of the current administration's trade policy. Fewer goods and services are entering the US economy, a direct effect of the new tariffs imposed by the administration. We saw imports peak around late 2024. The gap between imports and exports still sits at roughly $1.1 trillion, meaning the United States remains an importing economy rather than an exporting one. But the trend is clearly starting to reverse. Higher tariffs have raised import costs, prompting importers to rush and clear inventories ahead of tariff implementation. These are now the highest tariff rates seen in recent years. This is why we're getting to the so-called capital war going on right now. We're seeing the US net capital inflows in July 2025. It was around plus $248 billion. This means foreign financing of US debt has been quite high in recent months. We're also seeing that precisely since the beginning of this year, it's actually been dropping. It's still high in a historical context. However, you can see that the trend which began in 2023 and continued into early 2024 has now reversed. Such a reversal has been seen before, during 2008 to 2009, when panic demand for treasuries surged during the global financial crisis. A similar spike and subsequent drop also occurred during the 2020 COVID crisis. The latest rise from 2023 to early 2025 shows renewed buying of short-term treasuries as yields increased and global liquidity tightened. When we refer to the capital war, we're talking about the shift in how US deficits are financed. The strong rise in net capital inflows up to early 2025 showed that foreign investors were still heavily funding US debt through short-term treasury bills. The more recent decline, however, suggests a partial retreat, a weaker foreign appetite. The United States manages its economy through two main levers: monetary policy, set by the Federal Reserve, and fiscal policy, set by the government. In recent years, the Treasury has relied heavily on issuing short-term bills to cover fiscal deficits. If foreign inflows slow, domestic buyers, mainly banks and money market funds, must absorb a greater share of that debt. Historically, when that happens, the Fed often steps in with renewed liquidity injection, like quantitative easing, to stabilize the funding conditions. Since we mentioned quantitative easing, it's impossible not to examine the Fed's balance sheet. The balance sheet essentially shows the composition of the Federal Reserve's assets, and its evolution reflects the central bank's interventions in financial markets. The chart reveals three major surges in total assets, with other periods showing only gradual increases. These surges occurred during the 2008 global financial crisis, the 2020 to 2021 pandemic shock, and a smaller liquidity spike in March 2023. Recently, the slope of the curve has flattened. From 2023 to the present, the Fed has been engaged in what's called a quantitative tightening, meaning liquidity has been withdrawn from the financial system. Earlier, we noted a slight decline in foreign treasury inflows, suggesting a gradual reduction in external financing of US debt. The Fed's slowing pace of balance sheet reduction clearly tells us it is preparing to step back in as the domestic buyer of last resort. Whether this re-engagement would take the form of gradual reinvestment or another sharp expansion depends on the actual market conditions. The last part is currency war, and this is precisely the reason we've been talking of this whole topic as a global economic reset. Since the beginning of 2025, we're seeing the weakening of the broader US dollar index. This index is telling us how strong the dollar is relative to other currencies, and right now it's weakening, meaning, for example, you get more dollars for your euro or yen. It's important to explain when we're talking de-dollarization, we do not mean a weaker dollar. Weaker dollar, which is preferred right now by the current US administration, is a desired effect. It refers to dollar versus other currencies. However, de-dollarization refers to a structural decline in the dollar's global role as a reserve currency, settlement medium, or unit of account. It's about how many international transactions, reserves, and debts are denominated in dollars, not about the forex rate itself. So to wrap it up, the United States wants to preserve its geopolitical leverage by soft dollar rebalancing, competitive but still dominant. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glenaius.